And good afternoon. Welcome into Market Talk here on this Friday, May 20th. Great to have you with us. Thanks for joining us and making us part of your day once again. I'm your host, Jesse Allen. Find us online, markettalkag.com. That's our home on the web. Markettalkag.com is where you can find us. Facebook, Twitter, Instagram, all of our streaming sources, our radio affiliates, everything is there. Markettalkag.com. Well, it felt like today's grain trade, at least, was a deja vu of Thursday. We had the soy complex up sharply, wheat under heavy pressure, corn stuck in the middle. A lot to discuss there, a lot to discuss stock market wise, livestock as well. We have a cattle on feed report out this afternoon. Plenty to take a look at. Let's bring in our good friend Ted Seifried with Zaner Ag Heads joining us this afternoon as we wrap up the week. Ted, good afternoon to you, buddy. How are you?
Good afternoon, Jesse. I'm doing great. How are you, man?
I am fantastic. It is
Awesome.
Friday and
Mm-hmm.
ready for a nice weekend, but we have to digest what happened in this market trade here this week. And I got to start with the wheat complex because, man, what a tale of, start of the week to the end of the week. This just kind of becoming a bloodbath. It really doesn't feel like there is anything to stand in the way of the selling here as we look at the market on Friday in the short term, despite all of the weather production concerns here in the U.S. and globally right now, Ted. It just feels like there's nothing in the way to stop the selling.
Yeah, again, it's super interesting week for wheat in what has otherwise been a super interesting, I don't know, last few months for wheat with the wild moves that we've had, wild swings that we've had. And I think that was just a sort of a typical thing. But we came into the week for wheat with the idea that, hey, India's banning exports. Oh boy, they were slated to export, a sizable amount this year. And we're thinking, okay, that means more business and tighter global supplies, tighter global export market. Here we go. But then we kind of read into it a little bit more, and they say, well, we're banning wheat exports, but we've got a new friend in Egypt, and they want 500,000 metric tons, so we're going to sell them that. And then the wheat that we have at the ports still, yeah, let's sell that too. And then, if any country really needs wheat, we might sell that to them also. So really, yeah, let's ban wheat exports. But maybe every other Tuesday maybe every Tuesday or Tuesdays and Thursdays we might sell some wheat. I don't know. It just didn't. I don't know if ban seems to be the right word for that. It was exciting to talk about Sunday night into Monday, but the enthusiasm over that really kind of waned over the week. And in the meantime, we had a wheat crop tour, which, look, as far as I'm concerned, was really reflective of the poor conditions that we have out there. However, I think some people were disappointed with the yields coming in higher than what they were expecting. But I think what gets lost in the mix here, Jesse, is that there's probably a lot of fields that just weren't counted or passed over. Me myself being a participant in crop tour for not wheat crop tour, but pro farmer crop tour, looking at row crops for the last 7, 8 years. Uh, there are times when things are so bad that you pull up to a field and you look at it and you say, I can't count yield here because it's just not there. So you move on. You don't mark it as a zero necessarily. You just move on, right? Because that's not going to be reflected. Those fields aren't going to be reflected in yield. Those fields are going to be reflected in harvested acreage because they're not going to be harvested, right? So while that yield number may have come in a little bit higher than some people were expecting, I'm wondering what that harvested acreage number does, because again, I think that a lot of the worst fields are going to not be reflected in yield. They're just going to be reflected as a zero and come out of harvested acreage. So I don't know. It all goes back to the idea that things are never as good as they seem. Things are never as bad as they seem. When you have all this super bullish enthusiasm, and then we realize, oh, there is actually a bit of a wheat crop out there, then you have a bit of a sell-off. But that being said, from a technical standpoint, you look at July Chicago wheat, it looks like a massive double top from, about 10 days after the Russian invasion of Ukraine, when we had that short squeeze, limit up move, which I don't think was fundamentally justified at the time. But really, it was just simply that. It was a short squeeze. Your short positions could not get out of that July contract in particular. But fast forward a couple months, and now we do have the bullish fundamentals to be up here. And I don't think double tops, when I look at that, double tops to me aren't usually a topping formation. I think at the very least, we're going to go back and try those highs again. Doesn't mean that we can't come down further before that happens, but I would be surprised, I think, if we don't get back up towards those highs again and possibly make new highs. What I will say, Jesse, is that this might be the beginning of the overall topping formation that we might have in wheat. But I can't say for sure that the highs are in, and I'm not going to start panic selling wheat right here, right now.
Do you think one other brief thought in wheat? Do you think maybe end users are letting this market come back down to them a little bit, and maybe we're trying to make U.S. wheat a little cheaper on the world scale, possibly here? That feeling might be with me a little bit in the wheat market.
Sure, absolutely, Jesse. And I think buyers or sellers, right? With the volatility that we've seen in wheat over the past few months, that makes for thin markets, right? Because people can put their orders super far away and think, hey, that might actually get hit, and they do, right? So it makes for kind of thinner trading. Yes, you can take a step back. You can a couple of years ago, the ranges in wheat were really very tiny, comparatively speaking. So you'd have to have your orders fairly close to the market if you wanted to have a chance to get filled. It's a completely different ball game now, Jesse. So yeah, you can. You have that luxury of kind of stepping back and saying, hey, hopefully it'll come to me. And then if you have a technical point get triggered where it's going to force you to up or lower your bid, whatever you're going to have to do to change, then that can happen. But for the way wheat's trading, you have the luxury of kind of sitting back and waiting for those bigger numbers.
Well, Ted, let's move over to corn and soybeans here today. And it feels like this ebb and flow in the corn and bean markets. Beginning of the spring, we saw a lot of the money supporting corn. Now it feels like it's maybe shifting to the bean market a little bit. Despite corn, there's great export demand out there. We see cash basis, national basis is probably some of the strongest we've seen in 10 years. But it just feels like some of that money's flowing out of corn into soy right now. Can you talk
Yeah.
about that a little bit?
Yeah, and it comes at an interesting time, Jesse, because we're getting very concerned about the planting for North Dakota, South Dakota, and parts of Minnesota. So I mean, we were already looking at a low ball acreage number and planting intentions, and now we might not actually get there. So you think there's good reason to be fairly bullish corn. But also, it all goes back to that last WASDE report that we had and the USDA lowering old crop soybean stocks. And it seemed to serve as a really sharp reminder to everybody who, I don't know why, but had seemingly forgot that our old crop soybean situation is really rather tight. And then you have an export sales week of almost 750,000 metric tons of soybeans to really add fuel to that fire. Which, by the way, I really like that export sales report because we only knew about 132,000 of that. So there's a lot of these transactions that are being made under the radar. So we have to be on our toes. We have to assume that that's happening, even if we're not seeing these daily flash sales. But the fact of the matter, Jesse, is that the crushers aren't going to want to slow down. We have really good crush margins right now. Meal is starting to make a massive comeback. Soybean oil is very strong, and the demand for soybean oil is unprecedented for the history of soybean oil. Crush margins, I think, are going to continue to be really, really strong. By the way, on the meal side of things, we haven't really heard anything about bird flu for 4 or 5 weeks now, at least on the commercial side of things. I think we really stamped that out, which means that as we rebuild these flocks, we need more meal. We're more meal intensive than sustaining these flocks. Rebuilding is a much different story. So the meal demand is back in a big way, it seems, and our exports for meal are back in a big way. So not only do you have soybean oil that is justified to be at the current levels or higher, I'm going to say, but you have a meal market that got really depressed because of bird flu that is now has reason to come back in a big way. So I think you're sitting on a powder keg for old crop soybeans. And bringing it all back to your initial point or question, the professional traders are now realizing oh boy, this July in particular soybean crop has a lot of upside potential. So now we're doing the opposite of what we were doing before that USDA report, which was buying corn and selling soybeans. Now they're buying beans and using corn as the short end of the stick because they like to do these spreads. It creates less risk for them and so on and so forth, or at least they feel like it creates less risk for them. So that's just kind of how it's been. Long beans, short corn. You're seeing a lot of those positions going on, even though fundamentally there's reasons to be bullish corn as well.
Well, and still though, to your point, I mean, we look at the market in corn, and I wonder too. I've seen some guys, questions about looking out to 2023 sales. I mean, 646 at a quarter on December corn for 23,
Mhm.
still a pretty good price, Ted.
Yeah, I'm a huge advocate of looking out as far as you can in corn. Because the fact of the matter is that there is a bigger gorilla in the room here, Jesse. We can talk about grain fundamentals all we want. But at the end of the day, it might not matter one of these days, right? We have an inflationary bubble. And, if I were under a rock for the last 10 years and I just, walked out here today and looked at a corn balance sheet, I would say, wow, 1.4 billion bushel carryover on average between last year and next year. That's a pretty bullish number. We could maybe be at 550 corn, but not 750 to $8, right? A lot of that is based on inflation. So if this inflationary bubble bursts, there's a lot of downside potential here. And that's been a concern of the market, especially with the Fed notes that we saw midweek. I mean, we were down sharply on Wednesday, but that wasn't a grain fundamental thing. That was a $6 reversal lower in crude thing. That was a 1,000 point drop in the Dow Jones thing. That was a big concern by the professional investors that this inflationary bubble is over. Personally, I think it's going to get worse before it gets better, but at some point that inflationary bubble will burst. And when it does, you really need to be as sold as you can, as far out as you can. So these are the things that you need to be thinking about right now. I do think that we're going to enjoy another month to 2 months of strong prices and heavy inflation as the American public wants to go out and enjoy themselves for the first real free summer, spring into summer that we've had in a long time. We want to feel normal and we want to make up for lost time. But then by the time we get to middle of July, as we usually get into these, dog days of summer, we start to slow down. And this slowdown this year could be profound, especially if the Fed is getting more aggressive on raising rates. I have my questions about that, considering what's happened in the stock market, considering that GDP is down a percentage point. How aggressive can they get on rates? I don't know. But if they do, and that coincides with that summer doldrums slowdown on the demand side of things could get really nasty. And if it doesn't happen then, I really do feel like it could happen into fall, into winter. So we need to be taking advantage of these high prices as far out as we can. We need to be looking for opportunities here over the course of the next month and a half to 2 months.
Let's stay on the inflation topic and the stock market here real quick since we're talking about it.
Mhm.
It really feels like this week there is just almost a vote of no confidence across the macro
Right.
picture, even into energies a little bit.
Mhm.
A lot of concern about where inflation's going, concerned about the government not taming inflation here in the US. I mean, just looking at the stock market, biggest sell off since
Yep.
March of 2020, I think it was, in the Dow
Yep.
earlier this week, and seeing more losses today.
Yep.
What is your thought in this stock market, a little bit more how it's playing into everything, and just this general sense of no confidence out there right now?
Yeah, and so when you talk about inflation, the Fed can do things to fight inflation, but an easier way to do that, or the things that the Fed does to fight inflation, what they're trying to do is the end result. The end result is what actually fights inflation, and that's called wealth destruction, taking money out of the market. And you've got a stock market that's off to the worst year that it's seen in decades. You've got a cryptocurrency bubble burst, which, I mean, I I didn't understand that whole thing in the first place, Jesse. But to this point, we've lost about $1.7 trillion in market capital in the cryptocurrency market. Go back to 2007 into 2008, we lost $1.3 trillion in the subprime mortgage bubble burst. We're bigger than that now. So that last time triggered a massive recession. Um, are we headed for something like that this time? I think probably yes. But again, I'm really kind of hanging my hat on the idea that we're going to focus on these things at a later date. And the Fed is going to continue to get frustrated with inflation, even though they said it was transitory and they waited way too long to try to fight it. And now they're going to have a much more difficult time doing it. Um, but I'm really hanging my hat on the idea that we are going to ignore these things for a little while because we really want things to be normal for a small period of time. We want to go visit our friends. We want to cook out and grill and go on road trips and do things that we weren't able to do last year or in limited capacity last year, and certainly weren't able to do the year before. So I still think that's going to happen. And again, things usually get worse before they get better. And I think that is going to be the case for inflation. But the cracks in the foundation are there. And we have to recognize that. And we have to know that at some point, this is going to end poorly, right? And the Fed, I don't have very much confidence in them giving us this soft landing. And you look at the stock market, and there is a massive reflection of my sentiment there that they don't feel like we're going to see a soft landing coming from the Fed. So that is a concern going forward. Again, I think we get into a brief period of time where things feel better again for a little while. But I'm worried about that summer doldrum time frame. You know, what happens is we're getting into August and people have had their fun and start to slow down and, you know, start to realize, oh, you know, I've spent a lot of money on filling up my tank and at the grocery store. Now I really need to kind of cut back a little bit. That's when things get real weird.
Let's segue to livestock. Cattle markets fairly quiet, choppy today ahead of the cattle on feed report. Just getting those numbers out here this afternoon. Cattle on feed up 2%. Inventory was 2% above last year. Highest May 1st inventory since the series began in 1996. But you look at placements and marketings, though, Ted. Placements, let's see, down 1% from last year. Marketing's down 2% from last year. So getting those numbers here in real time, what is your thoughts with that report and just how that could parlay into the cattle market moving forward?
Yeah, so you know, I think the big number that we were kind of keying into was going to be that placements number, and you know, we're wondering what sort of animals we're going to have out there into the fall and winter months, and it seems well, things might be getting a little bit tighter further on. And, you know, that cattle on feed number at 102%, I think that's reflective of the fact that we have really had a slow start to this grilling season, fits and starts. I mean, the weather has not been good. We've had a couple brief, nice days, or even a week that was been good. And, you know, you see cash cattle tick up there when that happens. But we really need to get this grilling season started in earnest. And when that happens, I think we will work through that upfront supply. And then, yeah, you do worry about the animals out there longer term. But as we were just talking about when it comes to inflation and you know, the overall macroeconomics of everything, I'm not sure the demand's going to be as strong out there. I think demand's going to be hot and heavy for the first half of the summer, but when you get into those fall and winter months, I do start to worry about it. So, you know, I want to be bullish cattle, and I do think that we've done enough work to the downside in the short term because we've got such a discount to cash, and I do see that domestic demand really kind of perking up here in short order for a little while. But when I look out at the lower placements long term, and I look out at those contracts that are going further out into the end of the year, I'm not as friendly on those as I think some people are. I would like to see a recovery. I like the August contract. I think we're kind of carving out a near-term low here, and I think there is some upside potential. But if you get any strength in those back contracts, those deferred month contracts, I think producers need to be looking at those as hedging tools in the fairly recent or fairly short term.
How about the hog market, Ted? Yesterday we had a down day after a lot of days higher, and
Mm,
then rallying back today, midday, another
yeah,
strong day in the hogs. Great way to end the week.
yeah,
What are your thoughts with this hog market right now?
yeah. I mean, huge reversal higher there on today on Friday, which is a really nice buy signal on the chart. Which is a really nice. We closed over some very key what was resistance, which will now be support. So you have a really good looking chart on hogs. And you know, the concern for hogs, the bear cry has been, well, but the weights are so big up front. Big weights, big weights. Yeah. All right. Well, you know, going back to what we were talking about in live cattle, you know, that's going to back up some weights a little bit. But once we get started in earnest and we start having those cookouts and those grill outs and getting together with friends and things like that, I really think our domestic demand is going to be a lot better. Also, you know, a lot of people talk about how we have lackluster export sales, and yeah, they're lackluster compared to last year because you know China's not rebuilding their hog herd anymore. They've more than done that. So we knew that export sales were going to be down year to year because the big buyer wasn't going to be there. I look at export sales and I think they're pretty decent. I mean, I'm not saying they're fantastic, but I think they're decent enough that put that together with hopefully some rebounding or positive domestic demand, I think we can shoot through those weights pretty quickly, and I think we got a little bit on for new. Really, I think that what we've done just here in the past 2 months is we defined the high end of the range about 2 months ago, and then just in the last week we've kind of maybe defined the low end of the range, and now I think we can kind of trade sideways until we know more about what's going to happen with all the things that we've just been talking about, Jesse. Domestic demand positive for the next month or two, I'm hoping. But then what does it look like when we get into August and beyond? Are things going to start getting really nasty? And if that's the case, and if the stock market's continuing to drop, and I mean, if we're looking at that recession type scenario, then it's going to be hard to justify any of these prices in any of the commodities that we're looking at, really.
Very true. Ted, fantastic analysis as always, sir. If folks need to reach out to you, get a little advice on their marketing, I know they could do just that by reaching out to you there at Zaner. How can they get a hold of you?
Yeah, absolutely. You can reach me directly at 312-277-0113. You can also find us on the web at www.zaner.com. We've got a new app, by the way, that really helps. You can plug in your cash sales, your futures and options positions, and it gives you an idea of your overall portfolio of your risk management. And I think it's really cool. We've been developing that for the last couple of years. So take a look at that if you can. You can also sign up for our newsletters, which is a newsletter. It's not a recommendations letter. We do those personally on a one-to-one basis as we get to know our clients and their risk tolerances and things like that. And then finally, you can find me on Twitter. I'm at the Ted Spread. I've been talking a lot about this inflationary topic, and I've gotten really in depth with it here recently. But I also like to talk about cars and ethanol and things like that.
Definitely. Well, I have followed some of your inflation talk on Twitter, and it is an interesting read for sure. So you can definitely check that out on social media, and again, learn more as well online. Zaner, aghedgezaner.com. Ted, appreciate the time. Thanks so much. Enjoy the weekend. We'll talk to you again soon.
Thanks, Jesse. Look forward to it, man. Always love coming up.
Ted Seifried with Zaner Ag Hedge. That's going to do it for the show on this Friday, May 20th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.